A company that audits construction software, insurance, and financial products for property builders released a new report examining the impact that aging boomers have on the greater Chicago metropolitan area's housing market and the number of homes that are available to younger potential homebuyers. Boomers own 35.6% of Chicago homes amid a housing shortage, construction coverage said in an email to the Chicago Sun-Times. First-time homebuyers, especially millennials and Gen Xers, are facing an uphill battle when looking for a home, partly because baby boomers are planning to stay put, or as we like to call it, aging in place. While boomers do account for just over one-third of all residential occupants in the area, they only account for 19.9% of the population in the greater Chicago metro. Nationally, homeowners 62 and older hold an estimated $13 trillion in home equity as of the third quarter of 2023. That according to the December press release from the National Reverse Mortgage Lenders Association. This generational conflict in the U.S. housing market has been trending on several news outlets. Yahoo Finance's column, Baby Boomers May Be to Blame for Today's Housing Imbalance. And then there's Barclays investment bank economist Jonathan Millar, who notes this: the U.S. housing sector is on the upswing again, even with mortgage rates at a multi-decade high. Although much has been attributed to shortages of existing properties and mortgage lock-in effects, we think strong demand is a symptom of the aging population. An aging population that prefers to stay put and age in place. Of course, that will constrain housing inventory in markets that have a significant percentage of older residents who have smaller households. Now, it is expected that this trend will continue to grow. Trends for the 75 and up group are even starker, with the share expected to expand from 6% in 2010 to 9.5% by the end of this decade, then well above 10% in the decades that follow, said Millar. And this week, we bring you the monthly installment of Reverse Market Insights Market Minute with John McHugh. And John's going to dive into recent HECM data. And there's been a little bit of an issue with the data, John, but you also have, I think, a very important and, well, unexpected piece of data for us.
All right.
So
Well,
take it away,
thanks,
John.
Shannon, for having me back again. Obviously, this is going to be a little different than in months past. In part, unfortunately, the data that I usually use for the podcast is not available from FHA, or hasn't been updated, I have to say. So I thought I would pick up from where I left off last month, as far as what my thought was from an endorsement perspective for the industry. And we can see the full calendar year here now for the entire industry from January all the way through December. And I had said that we were going to be a little over 30,000 units. And as you can see, we're actually 30,550 when you sum up all of these units right here. So we did meet over that 30,000 mark. Again, I know this, in my previous comments as well, that, probably a little disappointing to most people, but I want to reiterate something I had brought up before. And this is a slightly different graph, but when we start looking from, especially from 2019 up through 2023, this is about the time that the PLFs really changed and we started to see a drop off in volume, pre-COVID. And then, obviously we had the refi boom, at the end of 2020 into 2022. But if we ignore the refinances and we just pay attention to the H for P and the new equity takeout loans that are here, we're pretty much in line. We have a few little spikes that are a little different here or there, but at the end of the day, we have been the steady. And what's really important is, even with this steep incline in rates and this high rate environment we've been in, we're still right on par with all the past years that we've had. Now, this is good and it's bad, right? That this hasn't changed a lot, but it's good that we're being successful in these challenging times. But there is some silver lining, I think, coming up in the form of H for P, especially, right? We can't do much about rates. Obviously, a lot of this new equity is going to have some to do with the rates and things like that. But the HECM for purchase. By the end of April, we're going to be seeing the new seller concessions, 6% seller concessions coming in on board. And that's really going to change the game. I mean, no longer are we going to be the ugly duckling of the mortgage world, but we're going to look just like our big brother, right? We're going to look very similar, at least, to the Ford program, and we're not going to be so different. And I think that's really going to have a huge impact overall on the industry, especially when we start looking at what's been going on in the HECM for purchase, especially over the last 12 months. We're looking around 2000, but that's kind of where we've been sitting for a long time. Someplace between that 2 to 3,000 mark. Some years better, some years worse. The last couple of years, it's been on the downward side, but that's because rates have been where they have been. Inventory has been very low. Cash has been king. Anything that was FHA, VA, those kind of went to the bottom, right? So there's lots of reasons why in recent past this hasn't moved the needle much, but I think this is bound to change. This is we're primed for this to really take off. And a lot of this just goes back to, I know Shannon touched on this in one of his previous videos, but the National Association of Realtors does this home buyer and seller generational trends report every year. And so this is the one for 23. And I've cited this report several times. And one of the things that's super important is it looks at who is buying and selling homes, right? And when we look at the younger boomers, the older boomer generation, and the silent generation, from a buyer standpoint, they make up over 40% of all buyers. 40%, right? They're well over 50 and pushing 60% of all sellers. Okay. That's not even talking about the older end of the Gen Xers that are already eligible for some of the proprietary stuff that are 55 and older, and soon will be eligible for the HECM 62 and over, right? The market is prime. It has been prime. Rates are up. Seller concessions are coming on board. These are the people buying and selling homes. If you haven't started getting out there and talking to your realtors and building those, or building those connections with realtors and educating this population right now, before this actually goes live, you're doing yourself a disservice. This is certainly going to be one of those areas of growth in 2024, but we have to get out there. We have to educate. We have to let people know, this is going to be an area of growth, hopefully for 2024, 25, 26, but it's up to you to get out there and educate. It's up to you to get out there and build those relationships. But I really think that we have a really good opportunity in 24 to do more than we did in 23 overall. So rates hopefully will take a little bit of a dip, will help us out on the new side. Seller concessions should definitely help us lift on the H for P side, because we can't be building on the refis. That's just not a stable way of doing it, but there are opportunities. So I wanted to share that with you this month. Hopefully next month the FHA data will be updated again and we can get back into the good stuff there. But appreciate it. You guys have a wonderful 2024 and go get them.
The U.S. Bankruptcy Court for the District of Delaware approved a class action settlement for the class of former LiveWell employees who filed suit back in May of 2019. They're seeking payment for 60 days of wages and benefits, alleging termination without cause and notice as required by law. Housing Wire's Chris Clow reports Monica Williams, a former loan account manager in LiveWell's Richmond, Virginia headquarters, had initially filed the suit just days after LiveWell had halted the funding of new loans, and subsequently they ceased operations entirely. Attorneys for Williams and the other former employees in the class lawsuit say that the figure provides for the payment of more than 66% of the maximum priority workers adjustment in retraining notification or WARN damages, and it also eliminates any further accrual of litigation expenses in the prosecuting of the action against LiveWell, including trial and possible appeals. Now, court filings reveal that payments would be capped at $13,650 per employee, and that includes all counsel fees and expenses, making the class consist of roughly 81 people. The filing is part of the fallout of the now defunct reverse mortgage lender, whose 3 former company executives were indicted over a reverse mortgage bond pricing scheme. And that's a wrap for us here at HECMWorld, bringing you the nation's only weekly podcast with reverse mortgage news for mortgage professionals, whether you're traditional or reverse. Don't forget you can share this episode on your LinkedIn profile. And we also have an audio companion edition, which can be found on Apple Music, Podbean, and now on Spotify as well. And of course, at HECMWorld.com. Thank you so much for joining us, and be sure to return next week for more reverse mortgage news on the go.